in the premium zone for a short trade entry. This specific Fibonacci retracement zone is from 0.62 to 0.79. The midpoint of this zone, which is 0.705, is also highlighted. In this illustration, you can see the OTE for a long trade. Notice how the zone falls into the discount zone. It's important to observe how price action reacts to the three levels of this zone, especially the midpoint at 0.705 retracement level. In this other illustration, you can see the OTE for a short trade. Notice how the zone falls into the premium zone. It's important to observe how price action reacts to the three levels of this zone, especially the midpoint retracement level, just like in the case of an OTE for a long trade. Let's take a look at a couple of examples of how the OTE works in real price charts. Here you can see the 4-hour chart of the Euro-USD. I already marked out an important swing high and a swing low. Let's now mark out the discount and premium zones generated by this range. Recall that a range is the distance between a swing high and a swing low. Let's also mark out the OTE or optimal trade entry for this range. Notice how the OTE falls into the premium zone. If price comes back to that level, we want to observe the interaction of price with each of the three levels that compose the OTE zone. By moving forward a few candles, we can see that price reacts to the 0.62 level of the OTE. Although you can use this as an entry, keep in mind that the higher into premium you get, the greater the risk-reward ratio you will extract from the trade. In this next chart, we can see that price reacts a little to the downside, but then returns back up to the OTE, closing above the midpoint, but still below the 0.79 level. In the very next candle, the market drops significantly. It takes just one more candle for price to reach the swing low target. If a short trade was triggered at the midpoint of the OTE with a stop at the swing high and a target at the swing low, the trade would have a 2.4 risk-reward ratio. In this final image, we can see that price continued going down afterwards. So even though a 2.4 risk-reward ratio is not terrible, there was a lot more that could be extracted from this trade. Let's take a look at a long trade example using the OTE. Here you can see that price just made a swing high. Let's first draw the discount and premium zones, and then plot the OTE using the range outline in the chart. In this next chart, we can see that price returns to the OTE into discount and reacts to the lowest level of the zone by touching it without closing below it. Right after, price begins to rise in the direction of the old high, swing high, or buy-side liquidity level. One major concept in the ICT method is the fair value gap. The fair value gap is a 3-candle pattern that hides a gap between the first and third candle's shadows. Let's first take a look at the bullish fair value gap, which is often called BC. BC simply stands for buy-side imbalance and sell-side inefficiency. The bullish fair value gap is a pattern where the upper shadow of the first candle doesn't overlap with the lower shadow of the third candle, creating a gap between the two. Let's make a quick comparison between price movements where we can find a fair value gap and one where we cannot. On the left, we can see that there is no overlap between the upper shadow of the first candle and the lower shadow of the third candle, therefore creating a fair value gap. On the right, we can see that the upper shadow of the first candle overlaps with the lower shadow of the third candle. In this case, there is no fair value gap. The bearish fair value gap is often called SEBI, which stands for sell-side imbalance and buy-side inefficiency. The bearish fair value gap is a pattern where the lower shadow of the first candle doesn't overlap with the upper shadow of the third candle, creating a gap between the two. Let's make a quick comparison between 3-candle patterns where we can find a fair value gap and one where we cannot. On the left, we can see that there is no overlap between the lower shadow of the first candle and the upper shadow of the third candle, therefore creating a fair value gap. On the right, we can see that the lower shadow of the first candle overlaps with the upper shadow of the third candle. In this case, there is no fair value gap. Another important detail about fair value gaps is the idea of consequent encroachment, which is simply a fancy expression that means the midpoint of the fair value gap or the 50% retracement of the gap. Fair value gaps can be used as zones of support and resistance. As is the case with many other types of support and resistance, it's important to pay attention to how price reacts to fair value gap limits and the consequent encroachment line. Let's look at BCs, or bullish fair value gaps, first.